So what do you do with earnings estimates? So if you take a look at earnings growth, like we're still looking at 3% earnings growth for the third quarter. Next year, everyone's talking about what it's going to mean for 2020. How do you start to think about your estimates?
I think that the near term, you're already is going to be fairly baked into the cake already. I think that it's the further out that is going to be the question. And I think that the earnings calls this quarter are going to be very key to what the market sees going forward. Because if companies are exceedingly cautious and saying we're doing X, Y, and Z because of the environment, I think that that is going to put earnings under pressure to the degree that people are not making decisions because they want to see what the outcomes are. And I think already you've seen some of the trade-related stuff like UPS and FedEx have some issues on their side because things are slowing down. So I think that's going to be a very important component of what happens over the next couple of weeks for this market.
And what I'm trying to get my mind around is sort of where the most re-rating is going to come, because you come inside the Bloomberg, this may be my favorite chart of earnings season. I always have one. This may be it. And it's looking at the Russell, the S&P MidCap, and the S&P 500 in terms of forward earnings estimates. S&P has held up completely while the small and MidCap have rolled over. What do you think about that?
Well, I think that sort of goes to the point of who can handle those problems the most. The bigger companies tend to be able to handle them the most. And I think that on the S&P, you've got a lot of tech companies where right now that's not so much of an issue for them. It may be coming as an issue for them, but it's not so much of an issue right now for Google, for Amazon, for some of those bigger tech companies. But the smaller companies, especially people who are using components, even if most of your revenue is in the U.S., if you're using components from outside of the U.S. and you're having trouble getting them right now, or you're paying more for them, it's harder to push those prices out. So the question is going to be how badly does the problems that we're experiencing on the trade front impact the margins. And I think that those estimates are showing you that for the smaller and mid-cap companies, it's harder for them to absorb that, and they can't make the changes that some of the bigger companies have already started to make in the last year or so as they looked up into this coming.
So do you feel like looking at the S&P closing yesterday at, 2938, is that accurately reflecting the risk or not that you're talking about?
I think that the market has made some assumptions about what's going to happen in the future that I think are somewhat optimistic.
Trade or Fed related?
Probably a little bit of both, but we'll see. Because if trade gets very bad, then you can assume that Fed might get a little bit better. I mean, I don't want to necessarily always make that trade-off that it's absolutely going to happen, but to the degree that the market is already assuming some Fed cuts that are coming in here, if the trade escalation situation gets worse, then it's possible that the market will start banking on more. But I think clearly last week when you had that big rally on Friday, that was the expectation of the perfect employment number. It wasn't too hot, it wasn't too cold, it gives the Fed room, but it wasn't a disaster because to the extent that bad news is not bad news, it can't be terrible news.